Howdy, folks. Jeff Camarda Tuesday, June 2nd, with your end-of-the-day COVID-era market report. Another kind of nowhere day in the U.S. markets, drifting up slightly. I think Dow and the S&P finished about 1% higher, so it's drifted up over the past couple of days. We are still mostly of the technical opinion. There's a number of folks on the board that we're kind of stalled here at resistance, and the next leg will be down. And just as an aside, technicals aside, and you've heard me say this many times over the years, I think that from a fundamental standpoint, U.S. stocks are significantly overvalued. They were kind of frothy before COVID hit last year and the highs that we had early this year. But the economic justification, the air out of the profits balloon for many, if not most companies, has been fairly sharply deflated. So we're trading at valuations that are even less underpinned by profits and cash flow because of the economic gut punch. There was an article in the Journal, I think, this morning where maybe 10 years before we get back to the economic activity of just a year ago. So for a lot of reasons, and I'm not sure that the bear market will continue, but I am expecting correction. I think we'll have the opportunity to get in with the remaining cash a lot cheaper than where we are now. And if not, we did deploy nicely about a third of the cash last week, and the markets are up pretty well since then. So we'll see what happens. On a kind of the financial education note, I thought today I'd talk about individual bonds. Our Camarda clients don't have them, but I talked to a new potential client this afternoon who had a lot of money in individual bonds and didn't really understand, as most individual investors don't, the compensation mechanics of the individual bond market. So think about this the next time you think about buying an individual bond or you're pitched one. Bonds trade at individual bonds at markups and markdowns. What does that mean? So let's say we have a bond that is newly issued bond. Par value is $1,000. The broker selling that will buy that bond from his trading department at a so-called wholesale ask price and then mark the bond up to the retail investor, and the difference, the markup, is their compensation. So just to use a dramatic example, and the percentage is high, but it's just to make the example, say that the markup is 5%, and you might pay $1,050 for a bond that the broker marked up from $1,000. And then if you want to sell that bond, and again, I'm exaggerating, say that his trading department is bidding or offering to pay $950 for that bond, right? They buy it $950 and they sell it wholesale for $4,000. That's how the trading department makes money. But now the broker's got to mark it down from $950. His trading department gives him $950, and maybe they give you $900. And that markdown of $50, he gives you $900, he gets $950 for it, is the compensation. So if you did a round trip on this sucker in this example, you paid $1050, but you're only getting $900 back out of it. And I've seen markups actually worse than that. And that's really, I know this seems confusing, so I'm going to end it there, but that really is just the surface of the complexity in the individual bond market. When bonds start trading as a result of changes in interest rates like we have now, where interest rates have gone down dramatically, the value of those bonds have gone up, are trading at so-called premiums, it makes it even more complicated. But that's probably far too much financial jargon for this now sunny afternoon here in usually lovely Orange Park, Florida. So until tomorrow, Wednesday, June 3rd, I bid you pleasant and placid, peaceful and prayerful evening. Thank you all so much. Bye-bye.